Regardless of whether you invest into dividend stocks, growth stocks, real estate, or even cryptocurrencies, you have to know what your tax consequences will be. And while different investments and strategies have their strengths and weaknesses, there seems to be a lot of confusion around dividend taxes in general. And obviously, the amount you have to pay in taxes can heavily depend on a number of different factors like your income, where you live, and whether or not you're using a tax advantage retirement account. But what most don't realize is that under the right circumstances, you could actually live off of $123,250 of dividend income and pay $0 in federal taxes in the United States. So in this video, I not only want to talk about the general tax implications of dividend investing, but explain one of the best kept secrets of the tax code that could allow you to potentially pay $0 in taxes on dividends. And if you like the information in this video, be sure to sign up for my weekly newsletter. Now let's dig in. Now the first thing we need to understand about dividend payments is there are two different types of payments. Dividends can be classified either as ordinary or qualified, and this is coming straight from the IRS's website. Now the main difference between these two types of dividend payments is the way that they are taxed, and to put it simply, we can see ordinary dividends are taxed as ordinary income at your regular tax rate, while qualified dividends are taxed at a lower rate, similar to the long-term capital gains tax rate. So what are some examples of companies that would pay ordinary dividends versus companies that pay qualified dividends? Well, an example of a company that pays ordinary dividends are typically going to be real estate investment trusts. So for example, it could be Realty Income, and also some covered call ETFs such as JEPI or business development companies. Now companies that would pay qualified dividends are going to be your more typical business structures. For example, Coca-Cola. This would be a business that pays out qualified dividends. So most of the time, investors will benefit more from receiving qualified dividends versus ordinary dividends. And let me show you why. What we're looking at here is the tax brackets for 2024. And keep in mind, we are looking at the United States. And again, we have to keep in mind we are looking at federal income tax rates. But like we just learned, ordinary dividends are taxed as ordinary income at your regular tax rate. So what exactly does that mean? Well, let's say in this example, we are married filing jointly. We can see based off this information, we start getting taxed immediately on our ordinary income, even if it's in the range of $0 to $23,200. There would still be a 10% tax on those ordinary dividends. But here's where buying dividend stocks that pay ordinary dividends can really hurt you. If you're in a very high tax bracket, the tax rate on those ordinary dividends can get very high, up to 35 and 37%. But keep in mind that is for very high income earners. And if we look closer to the middle or the average where most people are, ordinary dividend tax rates can fall in the 12% to 22% range, which can definitely make a difference in your overall returns. Now let's compare this to qualified dividend payments. Qualified dividend payments are much more tax advantageous. Let's again assume we are married filing jointly. In this scenario, you can see we can make up to $94,054 and pay 0% taxes on our qualified dividends. That's a pretty drastic difference compared to the ordinary dividend payment tax rate. We can then see after $94,000, it bumps up to around 15%, from $94,055 to $583,750. So again, better than ordinary dividends. And then for the very high income earners, anybody over $583,751, the tax rate on that would come out to 20%. That's way lower than the 32%, 35%, or even 37% they would have to pay on ordinary dividends. So qualified dividends are clearly more tax advantageous than ordinary dividends. Now there is a way to completely avoid paying taxes on qualified and ordinary dividends altogether, and that is with a tax advantage retirement account such as a Roth IRA. We can see all earnings in a Roth IRA, including dividends issued by companies the Roth IRA invests in, grow tax-free and can be withdrawn tax-free in your retirement years. This can be a great option for people looking to build long-term wealth tax-free. But here's something you have to understand about the Roth IRA. In order to withdraw that money without paying taxes and without paying any penalties, you have to be at least age 59 and a half or older, and you have to have owned your account for at least 5 years. So for people looking to reap the benefits of their dividends before that time frame, a Roth IRA might not make sense for you. So tax-deferred retirement accounts can be a great way to buy dividend stocks, whether they pay ordinary or qualified dividends. But now I want to touch on one of the best kept secrets of dividend investing, and that is how under the right circumstances, you could actually live off $123,250 of dividend income and pay $0 in federal taxes in the United States. And unlike the Roth IRA, there isn't a catch where you have to wait until you're at least 59 and a half. And this is something I talked about in my weekly newsletter just the other day. Again, I'll have a link down in the description below. And you can see here, we have a screenshot directly from the tax software. And in this scenario, this person was earning $123,250 in dividend payments. And if we look at the bottom line, we can see their total federal tax came out to $0. And here's what's really interesting about this. Generating $123,250 of federal tax-free money is almost equivalent to generating a before-tax salary of $165,000, since you'd pay approximately a 25% fee in federal taxes on your salary. And in other words, you would need to earn at least $165,000 from your day job to have the exact same net pay of $123,250 with qualified dividends. So we can see qualified dividends are way more tax advantageous than your actual salary from your 9 to 5. So how exactly does this work? Well, let's go through this example. If we scroll down, we can see again, like we've talked about, qualified dividends get a preferential tax treatment. And according to the IRS, if your taxable income is less than $94,050 and you file jointly, you will pay $0 in taxes. But here's something else we have to understand as well. The taxable income calculation is after the standard deduction gets applied. And as we can see right here, for married individuals filing jointly, the standard deduction comes out to $29,200. So if we keep scrolling down, we can see if standard deduction is $29,200 for married individuals, we can see what the maximum amount you can generate in qualified dividends and pay $0 in taxes is. If we come down here, here's married filing jointly, this is what we want to look at. We have our $29,200 standard deduction. The taxable income for 0% rate goes all the way up to $94,050, meaning you could receive $123,250 in dividend income completely tax-free. And keep in mind that is for qualified dividends. Now we can also see if we were single, this could go all the way up to $61,625. That would be pretty much equivalent to earning an $80,000 salary before tax. Now, something else we have to keep in mind is this only applies to federal taxes. You may have to pay state taxes unless you live in one of the following states like Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, or Wyoming. Now, one of the major concerns people have with this approach is, what about inflation? You might not be able to live off that amount forever, but we have to keep in mind there are two major reasons why this should not be a concern for you. And as we'll see, living off dividends can actually be quite sustainable even with inflation. And reason number one is tax brackets and deductions get adjusted with inflation. The standard deduction in 2023 was $13,850 instead of $14,600. The tax bracket went from $44,625 to $47,025. So the numbers always get adjusted accordingly to account for inflation. And then the second reason is something I talk about on the channel all the time. It's important to buy stocks and ETFs with a long track record of increasing their dividend payouts every single year. And just for a quick example, Starbucks has a 3-year dividend growth rate of 8.55%. So when you account for tax brackets being adjusted for inflation and also buying dividend growth stocks, you can easily outpace inflation. Now, another big question people have is, what if I have other income types? And this is a very reasonable question. But even if you have other income types such as wages, required minimum distributions from retirement accounts, or Social Security income, as long as you earn less than $123,250 if married, your qualified dividends will be taxed at 0%. And if you've built a large dividend portfolio, you will only pay taxes on the taxable income above $123,250, and that amount would only be 15% above that amount. So an example of that would be if you generate $200,000 in qualified dividend income, you will only owe approximately $11,500 in federal taxes and could potentially owe 0% in state taxes depending on where you live. And to put that in comparison to show you how effective that is, if you earn $200,000 income in a corporate job, you would pay around $37,700, which is around 3.25 times more than you would if that was dividends. And so the key takeaway here is the tax code heavily favors investors and especially dividend investors. Again, all that information was provided in my newsletter and you can check it out at the link in the description. Now keep in mind, like I mentioned in the beginning of the video, taxes can depend on a number of different factors like income, where you live, and whether or not you use tax advantage retirement accounts, and every investment strategy has its strengths and weaknesses when it comes to taxes. And be sure to always talk to a tax expert when trying to understand your own tax situation. So I hope this video helped you better understand tax implications when it comes to dividend investing. But with all this being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.